Leo Grahowski, where is investor sentiment heading into 2013?
I think investors are still very skeptical, very cynical about the markets in general. I think tone is improving, and there's a reason the market's up 16% this year, but I think generally investors are still very cautious and very skeptical, particularly around policy, around the economy. So I meet with investors all the time, and I think the tone is still skeptical is how I would describe it.
Well, because of that skepticism, they've been piling into bonds these past few years. Is there some danger there?
Yes. Bonds and money market funds. Last I checked, there was still $2.6 trillion sitting in money market funds here in the U.S., earning zero or close to it. And a lot of the money, as you mentioned, has found its way into bond funds. Many of them intermediate term government bond funds. Investors who want a little bit of yield but don't want to take the risk have found their way into intermediate term government bond funds. A lot of those bond funds are buying things like the 10-year Treasury note, which are today yielding around 1.75%. Investors don't realize that all it takes is a 50 basis point backup in interest rates. And our view is that over the next 12 months, we could see the 10-year Treasury around a 2.25. That negates the yield and actually provides a negative total rate of return 12 months out. So I think a lot of investors looking for yield are forgetting about the principal risk associated with something even as safe and secure as an intermediate term government bond.
So if you're worried about Treasury bonds, is there a part of the bond market that you like better? Because people still have to be in bonds.
Spread products in general, corporate bonds, all of that to us makes more sense than treasuries. If I had to pick a single sector, particularly for individuals, the tax-exempt market has backed up lately. There's some concern about the taxability of exempts, and investors can find good, solid, tax-free municipal bonds yielding more than 10-year treasuries that are tax-free. And I think certainly tax rates for upper income investors are likely to go higher. So tax-free municipal bonds, while they've done well over the last few years, still represent good value.
Well, that's bonds. Now let's talk a little bit about stocks. Are stocks cheap or expensive heading into 2013? And if they are cheap, which sectors do you like the best?
Stocks are attractive. Stocks are relatively inexpensive, and for investors who have a hard time understanding that, because as mentioned earlier, we're up 15% plus on the S&P this year, and the market has doubled in 3.5 years. What the market has done is track earnings, right? There's been no PE expansion associated with this market move. So if investors think about the market from the bottom up, there are still some very attractively valued securities trading at high single-digit PE multiples with yields of 2, 3, 4%. So the market is reasonably valued in our view going into the new year.
And any sectors that you like the best?
Energy has underperformed this year in a big way. The two underperforming sectors, utilities and energy. We're still avoiding utilities, but energy to me looks intriguing, and a lot of those single-digit PE multiple names with yields closer to 4% happen to be housed in the energy sector. So we like energy, and I think financials, while they've done very well this year and at the top of the heap, there are still some very attractive valuation in the financial sector, particularly among regional bank shares.
And finally, what about the BRICS? People have been avoiding emerging markets, at least in 2012, bringing their money back here to America. Is it time to get back into Brazil, Russia, India, and China?
Yes, and so much is dependent on time horizon, right? For investors that are worried about the next few weeks, if we get a dose of risk-off trading, certainly the emerging markets are going to get hit harder. But for investors with a 12 to 18-month time horizon or longer, excellent entry point for emerging markets. A lot of these markets have been painted with the brush of a China slowdown. We find the Chinese economy bottoming, yet the Chinese equity market, as one example, is still trading at or near a 4-year low. So this is, I think, going to turn out to be a good entry point for emerging markets. When you can buy emerging market equities as a whole at 13 times earnings, and the S&P is trading at around that same level, I think emerging markets represent an attractive entry point.